To expound on prudence, it's important for us to discuss the two types of prudence, which is your asymmetric prudence and your cautious prudence. So asymmetric prudence imposes a need for systematic asymmetry. What does this mean? Asymmetric prudence would require standards to indicate a different level of prudence for recognition of losses and gains. Under asymmetric prudence, there should be requirements in the standard wherein it would make it more difficult for entities to recognize gains and make it easier for entities to recognize losses. The idea of prudence under asymmetric prudence is that you choose the option that is least favorable to the reporting entity. If you are choosing between two amounts, you choose the amount that is unlikely to result in an overstatement of asset or income, regardless of whether it increases also your chance of overstating your liabilities or expenses. Because at least in such case, the effect would not be favorable to the reporting entity. On the other hand, cautious prudence is the need to be cautious when making judgments under conditions of uncertainty, but without needing to be more cautious in judgments relating to gains and assets than those relating to losses and liabilities. So basically, the main distinction between the two is that under asymmetric prudence, you intentionally choose the one that will be least favorable to the entity, while under cautious prudence, you are not taking into account whether the potential effect would be favorable or unfavorable to the entity, but the requirement is to simply exercise extreme caution. So in a way, you can say that the present framework has actually adopted the cautious prudence. However, the framework also acknowledges that it is possible and it is allowed that standards can provide asymmetric requirements. Best example would be your PAS 37, recognition of your contingent liabilities. The present rule as provided in PAS 37 is that we have a higher requirement before we recognize a contingent gain in the financial statements compared to your contingent liabilities. When a contingent liability becomes probable, then it will already be recognized as a liability. Whereas when a contingent gain is considered as probable, then it will only be disclosed in the notes to the financial statements. So to simplify the example, PAS 37 sets out a more stringent requirement before a contingent asset is recognized when compared to the recognition requirement for contingent liabilities. So to recap, the present framework may have adopted cautious prudence, but the present framework recognizes that standards can provide asymmetric requirements for certain assets and liabilities. But in case there are no specific requirements in the standards, then financial statement preparers should observe cautious prudence. So the last element of your faithful representation is freedom from error. This does not mean that the information must be accurate in all respects. This only means that there are no errors or omissions in the description of the phenomenon, and the process used to produce the reported information has been selected and applied with no errors in the process. And very important note mentioned in the framework, even a high level of measurement uncertainty does not necessarily prevent such an estimate from providing useful information. So the requirement of freedom from error does not require that the reported amounts must be perfectly accurate. This fact is important because remember that in general purpose financial reports, we allow the use of estimates and judgments. So how then do we comply with the freedom from error requirement? We just make sure that in the process of arriving at our estimated amounts, in the process of applying our judgment, we do not commit any errors or omissions. So just like in the example I mentioned earlier about the estimation of your liability on a pending litigation, so even if we use estimates, the faithful representation requirement is still considered complied with so long as the estimate is clearly and accurately described in the financial statements, that we provide sufficient disclosure as to the nature and the limitation of the estimation process, and we did not commit any error or mistake in performing the estimation process. So again, even a high level of measurement uncertainty does not necessarily prevent an estimate from providing useful information. Another important concept in faithful representation is the substance over form principle. Normally, the substance of each transaction conforms to the form of the transaction. But there are instances in which the form tells us one thing while the substance tells us another. The most common example here would be your leases, rental agreements. There are some rental agreements that are actually not lease agreements but are instead a sales transaction. You make it appear that you are just leasing an asset when in reality you're actually selling it already to the supposed lessee. So to comply with faithful representation, if you know that the transaction is actually in substance a sales transaction, then it should be reported as a sales transaction and not as a rental transaction. The financial reports should show the true substance of the transaction regardless of its form. So in a way, it is the substance that will prevail over the form of the transaction. In order for us to say that the transaction was faithfully represented in our financial reports. So the framework also tells us on how we are going to apply the fundamental qualitative characteristics. The first step is to identify an economic phenomenon. Identify the transaction that we will try to report. And information about such transaction is capable of being useful to users of the reporting entity. Otherwise, there will be no need to report such transaction because it will not be considered as relevant. Second is to identify the type of information about that phenomenon that would be most relevant. And the third is determine whether that information is available and whether it can provide a faithful representation. So you look at the transaction, identify the most relevant information that can describe the transaction, and determine whether such information is available. So if based on your assessment, you have concluded that the most relevant information to describe the transaction is available, then that would be the end of the process. If ever the most relevant information is not available, then you go to the next most relevant information and again determine whether such information is available and whether it can still faithfully represent the transaction. So it's possible that there will be a trade-off between relevance and faithful representation just for us to be able to provide useful information. Because no matter how relevant the information is, if it is not available and if it does not faithfully represent the transaction, then it will not be relevant to the financial statement users. And no matter how faithfully an information represents a transaction, if it is not relevant, then it will also not be useful to our financial statement user. Another way of illustrating the trade-off between the two fundamental qualitative characteristics is when the most relevant financial information is highly uncertain. The problem there is if the information is highly uncertain, then that means its ability to faithfully represent the transaction may be very weak. In such case, we compensate for the uncertainty of the information by providing additional disclosure in your financial statements. But if we conclude that the uncertainty is too high, that it no longer faithfully represents the transaction, then the best thing to do would be to proceed to the next most relevant information. And if such information still cannot faithfully represent the substance of the transaction, then the entity may be forced to simply not use any estimates at all. The entity will have to exercise its judgment in balancing relevance and faithful representation. So that would be all for your fundamental qualitative characteristics. Again, we have two: relevance and faithful representation. And information is relevant when it's capable of making a difference. And information is capable of making a difference if it has predictive value or confirmatory value or both. Materiality is defined as the ability to influence a decision, and in a way, materiality is just actually an entity-specific level of relevance. The second fundamental qualitative characteristic is your faithful representation. The elements of your faithful representation are completeness, neutrality, and freedom from error.